Again, I'm Jim Sheils of Southern Impression Homes. We are new construction turnkey specialists. We do not do old properties. We give lots of reasons why. I'm sure you've heard them before. The new construction is outperformed not only in growth, but also in much less headaches, which is something we all appreciate. We're building very heavily in Florida still, not in Miami, not in Orlando, not in Tampa, and for good reason, which I'll talk to you in our major findings for 2025 tonight. We've also entered Texas, Tennessee, and North Carolina. It's pretty exciting to be able to have this momentum. Again, this only started 10 years ago in Jacksonville, Florida, and to be expanding to these states, we're very excited about that. Okay, three is a charm. I apologize. Technical difficulties. I think things just don't work in Florida when it's cold, and that's very rarely. So again, I appreciate you guys for being here. We'll keep you on time. Again, you know who I am, partner of Southern Impression Homes. We stick to our new construction, single family, duplex, and quads, anything from whole communities to individual properties. Building very heavily in Florida still, as you guys know. It's definitely still our favorite market. We stay away from the expensive markets, Tampa, Miami, Orlando. We're seeing some interesting things that are happening with those markets. We're glad we're not a part of them. And we're now in Texas, Tennessee, and North Carolina. We look for five factors: economic growth, population growth, affordability, which is one of the key things I'll talk about tonight, desirability, which not only includes the lifestyle draw, but are the landlord laws friendly, and healthy supply and demand. Obviously, as builders, we don't want to go in and be building someplace that's oversupplied. We want to go where there's an undersupply. Best-selling book. Our book, thanks to a lot of you, went to a top seller on USA Today. This was a passion project of my wife and I, Chris, my partner, the whole staff, many of our clients. And it really talks about this niche of owning new construction rentals instead of the old fixer-uppers, and what it's done for people's lives and how it bought back their time, and they're spending time with their family, doing the things they want. And so get a copy of this book. In fact, if you want a free copy, just contact Jaden. She's on the call, Jaden at 18 Summers, and she'll make sure that you get a free copy of the book. Right now, guys, we got almost $1 billion under asset management, which we're very proud of. And along with that, 56 million in recurring revenue. It's created almost 200 million just in the last few years for our investors. We have over 1,000 active current investors, and that's growing on a weekly basis. We've developed over 9,000 units. Those are housing over 10,000 residents. We have a team of over 120, and that's growing by the week as well. We've really put together a great team that I'm super proud of. And to get started with us, it's an $80,000 minimum investment. We like to bring this up because we're not a match for everybody, but we know if you have an $80,000 investment to start with, we can build you a successful portfolio within a short amount of time to get the goals that you achieve or want to achieve. We currently have over 5,000 lots in Florida that we plan to build out with our parent partner, Sumitomo. A lot of you guys know we're partially owned by Sumitomo Forestry now. They are building 17,000 homes worldwide. We are one of the only builders of our size with no bank debt. We do not have any bank debt, which puts us in a very solvent situation, protection for our builders, and we build everything on our dime for our people, so you never have to get a pre-construction loan or anything like that. If you had invested $250,000 5 years ago into the S&P 500, you'd done okay. You would have gotten a 10.5% return. If you had invested in a solid real estate fund that did well, those were averaging about 13.5%. Again, another solid return. However, when you're an active investor and you actually own your own properties, there's a reason why the funds and syndications come to us. They want us to be able to invest so they can own the properties. But if you choose to own the properties yourself, it's very interesting. If you look at this, anyone who invested the average of $250,000 5 years ago in our Jacksonville new construction rentals would have earned over 69% on their money year over year. That's the power of buying in the right markets at the right price and the right timing with the right management. And those are all the things that we aim to supply to our clients. Now, 90% of all millionaires became so through owning real estate. That's why I went into it originally, because I like those odds and I like the tangibility. And a lot of you know my story. I came from a very middle-class family, but I had some big goals, and real estate really did plug me into the ability to have all the things that I dreamed of from the age of 11. Now, prosperity in the age of decline. I'm a big fan of ITR economics. This book changed my life. I read it about 12 years ago, and it changed the trajectory of where I was looking to invest and the type of properties I wanted to be involved with. And I give these guys a lot of credit for the decisions that we've made. And I follow their economic trends very closely because they've called everything to a 94% accuracy since 1982. And if you look at this, this shows as of December 2024, where the different industries are in their stage. And there's a couple of different stages. There's recession, there's slowing growth, there's accelerated growth, and then recovery. Now, if you look at the very center bottom, where is housing right now? Well, housing is coming out of a final recession from the last 2 years because of interest rates and what happened with the COVID inventory all, being delayed. And at this time now, we're just going into the recovery phase. Now, I don't have to tell many of you when is the best time to buy. The best time to buy is at the end of a recession, going into a recovery period. And these are what we're seeing from our statistics, and our friends at ITR are seeing as well. So we're very excited to be going into this year with wind at our back. And again, one of the things that has signaled us to know if the market is waking back up is we love our Main Street investors. Again, we have over 1,000 active investors, but we do also work with the institutions. And these guys are very methodical and their pencils are always sharpened. They come back into the market when they see these signs. And it was very quiet with our fee builds. And that means some of these big institutions will come to us and hire us to build them an entire neighborhood, to build them an entire unit complex. Well, this year, after being very quiet in the last year, we've almost contracted an additional 1,000 units just in our markets for the institutional buyers, which tells us they are seeing signals where it's time to bring their money off the sidelines to start investing again. So we always trickle our Main Street investors to let them know this, that these guys have started silently coming off over the last 12 months, and we're seeing an acceleration already into the first week of the year. In fact, I was on a conference back in September, the IMN conference, one of the largest commercial real estate conferences in the world. And I got invited to sit on the panel with some of the bigger hedge funds and builders. And what they all agreed to, there was a collective opinion that once rates took about another 2 drops, there was $900 billion coming off the sidelines into the type of housing that we like, and that's affordable workforce housing. So there is a very interesting thing happening this year where we're seeing a lot more money coming off the sidelines, and we see a lot more opportunity, especially if you time this right. We're going to talk about that tonight. We're building larger communities. People have said, are you sticking with just building smaller single-family duplex and quads? Well, we build whole communities now. This is one of the ones that we're doing right now in Ocala, Florida. It's a 60-unit building. And we're attracting some bigger buyers. Again, this might not be for you, but we are trying to help our Main Street buyers and some of our larger family offices and such. And these types of projects are not only good for our building experience, but help get the word out of who we are and the different people that we can work with. Now, these are the most important things we're going to go over tonight, guys. These are the key indicators for real estate success. All right, so take note on these. We'll get you copies of all the slides. All right, so first one, don't wait for interest rates to drop. You don't have to if you're going to be working with us. Everyone's talking about waiting for interest rates to drop, and I get it. You want interest rates to drop so you can get that lower rate, so when you pencil out the numbers, the cash flow makes sense. When you're working with our company, because we have a really good balance sheet, we're able to qualify for something called a builder forward commitment. This is really important. If you want to learn more about it, talk to your property counselors about it. But we are now not only in the house building business and the property management business, but the mortgage money business. We are buying money for our investors like you at lower rates so you can lock in well below what banks are advertising today. In fact, do you want to look at our terms right now? We can lock you in as low as 3.75 to 4.25. And any bank you go into right now, if you're trying to buy a single family home or a duplex, you're looking at probably about 3% higher than that. And for any of you doing the math, and again, we can go through the performance with you, this is the make and break between negative cash flow and positive cash flow. And a lot of people are on the sidelines because they don't want negative cash flow, but they can't get the financing. In fact, if you just walked into a bank, you would not be able to buy this down. They won't allow you to. You have to have certain financial credentials. And luckily, we've built ourselves up to be able to qualify for this and then pass the interest savings along to you for your long-term mortgages. This is the main reason why small investors are beating the institutional buyers. The institutional buyers for those rates that I just showed you, they can't qualify for those. This is only for small individual investors that qualify for the loans and own the properties. The large institutions cannot get that. So that's why that 900 billion is still sitting on the sideline. They need a few more rate cuts to jump in. But our buyers, our Main Street buyers, they don't have to wait for that. They're able to take care of it right now, jump in right now, and get the results and the lower rates without waiting for rates to drop like the rest of the world is talking about. Now you see it, now you don't. This is really important. I want you guys to hold me to this. Every one of you on this call, I want you to get back to me in 6 to 8 months and hold me to this. Now you see it, now you don't. There is an inventory shortage coming, especially in the key markets that we look in. It's not an opinion, it's just statistical fact because of some very clear factors that we've seen happening. There is going to be another inventory shortage occurring. The Sunshine State right now, this is pretty interesting. Only 25 affordable and available rental homes for every 100 workforce housing renters needed. So we are already behind on housing here. And as a country, we are 4.5 million short on existing homes. And a lot of you know that we still haven't caught up from the 2008 meltdown. That's when building slowed, especially on workforce affordable housing. Remember, that's where we build the luxurious homes and the bigger homes. That's not our focus. We like our smaller single families, our smaller duplexes, our quad developments. And that's the type of housing that's missing right now. And we're very excited. So this is going to cause an inventory shortage. We're going to have a bit of a freezing right now. Affordability, guys, is key. That's the issue that we're dealing with right now. That we have to approach. Affordable markets, and I'm going to show up some stats in a minute, are really what are driving continued real estate success. It's the more expensive markets where there was a lot of emotion. And again, I love Miami. I love Tampa. I love Orlando. I have family and friends there. I'm glad I'm not invested in those markets. They've gone way above where they're supposed to be. The family median income is not matching the pricing of the home, and it's putting them in a pretty tough situation that we don't want to put you in. That's why we're in those second tier markets where they might not be as popular, but there's lots of growth. There's lots of population growth. There's economic growth. There's good job source. These are the things that we want to look for you guys. So we'll get to chat at the end of this. Sorry about this. All right. If you look at this chart right here, if you look at right over at January 2023, that's actually February of 2023, where the peak happened for supply and demand. This is for units being authorized, the permit. Permit issuing is very, very, very depressed right now. It has been going down very consistently since February of 2023. That's when it peaked. Now, that peak of permit issue takes about 2 years to work through. And then after that, you see about a 6-month trail of when inventory levels start to drop. Because when you're building houses, you have to do the permit issues. And when you do that, it takes time. You can't just build a widget in like a month. It takes 2 years normally to go through this. So what we're seeing is by about July, August of this year, all of this extra inventory that was finally issued and permitted is coming through, but permits have been so far down, we're not seeing anything coming behind it. There's nothing in the workforce housing coming behind it. We're one of the few builders still building at our volume. And what we're seeing for the absorption that's going through, this is going to show very strongly by Q3 of this year, meaning that usually puts an upward pressure on values and on rents. And population growth. This is something that you want to look for in the markets that you go into. Again, you've heard me talk about this before. I love the Southeast, but we don't build in Alabama. Why? Because we want that wind at our back for population growth. If you look here, since the 1960s, Florida has been going like a hockey stick, continues to. Alabama, we don't have that big of a growth. It's steady, but if you start to build too much there, there's no one there to absorb it. So that's why we've avoided that market. A lot of people have been talking to us, guys, about, oh, Florida has so much inventory on the market. I found that really interesting because what we've seen, and again, I pulled this up today with the help of my team, was this is the residential listings, number of listings for Jacksonville, Florida in 2019, which was by all measurements a very normal market. That's before COVID. And then right here of December of 2024. So 5 years difference. If you look, the number of listings is pretty dang close to what it's supposed to, what it was back in 2019. But a lot of people are saying, well, I've heard there's so much inventory. Well, that makes sense. And I'll tell you why. Because if you look at December 19th, by December of 2020, we had one of the record low ever lowest inventory available in Jacksonville, Florida, ever. And in most Florida markets, that's when the pandemic came in, real estate became very popular, people weren't able to build quick, and we had the lowest number of listings on the MLS ever. Now, that's why we're seeing right here almost the same numbers, and not because of another pandemic, hopefully not, but because of just the absolute attrition of builders getting permits and building. We see that we could have another inventory shortage the same way December of 19 saw one year later. We're saying the same thing here. By December of 2025, we feel very confident there's going to be a shortage on housing. And where do you want to be when there's a shortage on housing? Already owning your own properties. So affordability wins in 2025, but beware of these properties. The properties I'm talking about, old fixer-uppers in bad neighborhoods in states that have bad landlord laws. There is a lot of garbage out there, guys. We've seen so many people over the last 20 years come and go who were trying to do turnkey real estate for people, but they weren't investors themselves. They were buying in tough neighborhoods. They weren't rehabbing the properties right. There wasn't management in place, and there were bad landlord laws. Just because it's affordable doesn't mean it's good. That's why we only do new constructions and high growth markets. But if you stick to affordable that also have these positive things, again, reminding you, economic growth, population growth, good affordability, yes, but is it desirable? Is there healthy supply and demand in that area? That's important as well. We gave them up a long time ago. I warn you on the old fixer-uppers in tough neighborhoods. It's not a great recipe for long-term happiness and definitely to avoid headaches and mistakes. All right, I wanted to show you this real quick. Again, when we talk about affordability, we hear the markets are always maxed out. We're getting a lot of buyers from Salt Lake City, Utah right now. Median home value there, $598,000. Median household income, $75,000. Look at Jacksonville, almost half the median home value with a very similar median household income. These are the things that you guys need to be looking for, and we look for, say, where is affordability still in good synchronicity? Is it Salt Lake or is it Jacksonville? Well, in our minds, it's Jacksonville. That's why we're investing and building so much there. And we feel it still has a safety net of margin to continue to grow compared to like a Salt Lake. You look at this, affordability index is something you need to understand, guys. That's just dividing the household income into the home value. Test this out. Look into different markets. Try this. You know, to get over a 20% affordability index like Jacksonville, that's a very high rating. You're getting below 15%, or some markets getting below 10%, makes cash flow really hard, and you're putting yourself at a risk where it could possibly be overvalued and have a bigger fall in a correction time. Same thing with all of our friends in Orange County, California, probably a few of them on here right now. You know, 1.1 million, almost 1.2, and a good solid household income of over 100,000. But not that big of a difference, you know, compared to the absolute pricing of Jacksonville. And you look at this affordability index, below 10%. Like I said, once you go below 10%, you are speculating. There's a lot of emotion in the market. It could never go down. But again, what I've learned, I remember my first mentor told me a house is worth what it rents for. And this is one of those numbers that you cannot ignore. That's why we love Jacksonville. And this is one of our more expensive markets compared to our Ocala range and other Central Florida areas. The Ocala duplex, speaking of which, this is one of the products we're most excited about because affordability is key. you're still able to buy two units under that one roof for less than 400,000 with great rents and great returns in one of the best growing markets in Florida. So if you're interested in something like that, talk to your property counselors. These are definitely one of the newer things we've done. We did these a few years ago, and they sold out. We're just finally getting them approved to do a whole new neighborhood of duplexes in some strategic areas. So I'd encourage you to talk to your property counselor. These are one of my favorite picks for 2025 because it's one of our most affordable markets. Duplexes have great rental yields. They're easy to resell to both first-time home buyers and to investors, and the numbers work really well. So you might want to check that out. Ocala single family home as well, still under 300,000 for a nice solid single family home over 1,400 square feet, real popular model. And again, not only is it going to get you a good rental yield, but a resaleability down the road. No one talks about that anymore. If you're going to own a property, someday you may want to sell it and you want to be able to sell it. I'm not proud to say that there's some investment properties I bought many, many years ago, gosh, almost over 20 years ago, that they were not easy to sell. They were easy for me to get, but not easy to sell. You want something with good resaleability. It's another reason why we only do new construction. So any questions? Oh, someone raised their hand. You want to just type it into the webinar chat box? Or does someone want to be called on? Oh, here they come. What's your prediction for the 2025 real estate market? Well, as I was saying, my prediction is there's going to be growth in the affordable markets, and there's going to be quite a race into real estate once rates start to drop and the institutional groups come in. I think that's going to put an upward pressure on price and on values. I think we're going to be pretty flat for the first half of this year. I think that's something we all agree with. But as we work through and absorb this inventory and rates start to drop, I think there's going to be a big boost, especially again, landlord friendly cannot be discounted, guys. So I predict that we're going to be flat in the beginning of the year. And then I don't even want to gander to guess what the jump's going to be by the end of the year. But I've seen and I've held property in some great times when we go into inventory shortages because that puts a pressure on both values and on rents. Please type the email address that we put up. Great. So Jaden just put that into the webinar chat box. Thank you, Kenton. That's in there. We'll get you a free copy of the book. We appreciate that. What would you say is your highest growth market? Conversely, what would you say is your highest rental yield market? Okay, that's a great question. I'm going to say our greatest high growth market probably right now would be Palm Coast. A lot of good things happening there, a lot of medical happening there. It's one of our nicest coastal markets, still with an affordable price, unlike, South Florida. So I'd say that's probably our highest equity growth market. Our highest rental yield is definitely Central Florida. Citrus Springs, Ocala, Inverness, these are all great markets. I was just out there. I don't know if some of you saw the post I did the other day. I was out there on New Year's Day with my family at the Springs. Beautiful market, most affordable, and it brings the highest rental yield. Okay, Rick, you wanted the address as well. We got that up for you guys. Jen, thanks for trying to help me with the Q&A. With inflation kicking back in and anticipations of less numbers of rate cuts, how do you see interest rates coming down? I see interest rates coming down, but not by the significant amount that everyone thought. Again, here's the advantage for what I really like. We don't have to worry about interest rates coming down. In fact, for us, we're okay if interest rates barely come down. Reason being is the fact that we have this builder forward commitment. We don't have to wait for the Fed to drop rates and then the Treasury to be affected and then get those better bank rates. We're creating our own mortgages. So you don't have to wait on that. I do think the market's going to drop for the general public. They're talking about that. They were originally saying 4 to 6 rate cuts. I think it's still going to be 2 to 4 now. And it's not going to go down to 2020 pricing or 2021, but it's still going to go down. We're not going to see that though till the second half of the year. At least that's what the people I follow, like ITR and some of the other people that we follow, James Burns, are saying. But good question. Anyone else have a question? What would you say the top housing type in demand is? Well, I think, Abu, the top housing in demand is always a single family home. always a single family home. It's the most proven asset class in real estate, really. So a single family home is always the most in demand, especially when it's workforce affordable housing. But then other things are just as much in demand. The duplex is a really interesting product. The duplex allows you to be in a single family home neighborhood a lot of the time with two rents, higher rent yields. And again, when you sell it down the road, you could still sell to a first-time home buyer. In fact, we've done that a lot. When our investors have decided to sell, they've made money, they've sold it not to another investor, but to a first-time home buyer. So that's something that you want to look at. But I'd say it goes in order in demand. It goes single family, duplex, and then quads. We are seeing that changes in different markets, but that would be the general order. Jen, do you also assist when it comes time to sell? Approximately, what are your terms and fees? Yeah, so we help people sell. We've helped many of our clients resell properties. They buy a portfolio with us, they hang on to a few, they sell a few. We're here to help sell them. And depending on the terms and fees, we'll sign a couple month contract, normally at the normal 5 or 6%. Kenneth, I'm sorry, Robert, what are your property management fees? And are you experiencing any challenge in filling up larger multifamily portfolios? So our fees are 8%, along with 75% of first tenant filled. We will get you that agreement from our property counselors. Now, we do have incentives right now where the management fee, the monthly fee, is waived for the first 2 years. Are we having challenges in filling up larger multifamily properties? It depends on the area. Jacksonville has been a little bit slower on some of the quads and then faster on others. And that's the only one we're filling in right now. Ocala is completely full. We are not having hardly any problems at all filling up the Ocala quad developments. And those are the two markets that we're building quads in. But when you say larger multifamily too, we're also building some duplex communities, and those are renting very quickly. Now, again, I want to caveat that with saying they're renting, between 30 and 60 days. We used to aim for about 30 days. Now it is between 30 and 60 days normally on a normal market because we are working through some of that COVID inventory, but the absorption is looking really good for that inventory that all came on. Property management fees. Okay. In what area of Texas, North Carolina, and Tennessee are you guys planning to build? There's a couple different markets we're going into. We're just outside of Dallas and looking at a few others right now. North Carolina, we're outside of Raleigh. And in Tennessee, we're looking at two markets that I don't want to disclose just yet, but it's markets that you guys are going to know and are pretty popular. How is the market in Southwest Florida, Cape Coral and Lehigh Acres? How do you see market progressing this year? So Southwest Florida is a very interesting area. So that was the #1 growth area, according to the Schillinger's report in 2021, right? Everybody moved there. Everyone was going there. It took forever to get work done down there, to find subcontractors, materials. It was the toughest part in the country to build in. So what we saw was a lot of inventory finally come out the beginning of this past year all at once. That slowed down again from about 30 days to about 67 days to get properties rented, and it slowed the market down. What we're seeing though, that market is starting to work through very quickly this absorption. So what we're seeing is flat rents. Our values are staying pretty steady on that. And we're expecting by the second half of the year, again, that's one area for sure where permits are extremely low. They haven't been issued. So we're seeing by this third quarter of this year that there should be probably a jump. We can't promise that, but again, this is simple supply and demand. If we go into an inventory shortage, that's what we're seeing for Cape Coral and Lehigh Acres. We already saw a drop in rents through the last year and a half. That, has seemed to steady, but we're going up the other side now. We're at a flatness right now, and we expect to go up the other side. Is there any rental placement guarantee promos like this? What we do have, Karen, is a rental protection program. And our rental protection program is this. If your property is not rented in 90 days, we will pay the next 90 days of your rent that's expected. We don't rarely, ever, I can think of one complex where it took ever longer than that. And we've done, several of these. So that pretty much gives you protection to make sure you're in a good position. So your exposure is 90 days, we pay the next 90 days. Is there any markets you're now going into in Tennessee? Okay, not going. I can tell you, if you're saying what markets are we not going into, we're not going into Miami, Tampa, Orlando. Those are way overpriced from what we're seeing. There's way too much emotion. The numbers don't make sense. Are you not? Now you're going into Tennessee. Yes, we're going into Tennessee, Rick. We'll keep you posted on that. Also, has there been renter demand slowdown again in Palm Coast? Thank you. No, Karen, Palm Coast is one of our best renting markets. So actually, Palm Coast was a really good case study for us year before last. We saw that there was a slowdown, a lot of things coming on the market. We sent out a few videos, my partner Chris and I, and said, we're going to pull back on some starts of our new construction. We're going to do some marketing. And I know it was September of 2023. September of 2023, we had about 87 units that were going onto the market. And by the end of the year, we were down to seven units. So we feel great about Palm Coast. I think there was a one point where a lot came on the market, but the value seems steady. It's one of our most popular and desirable to live in markets. We feel really good about it. One more I wanted to add to insurance. I get a call a day from insurance, whether it's an investor, a friend from up north, a family member who's invested in real estate. And what they say is, can we get insurance in Florida? I heard you can't get insurance in Florida. For new construction builders like us, building in the right area, building the right way, building to the right land height, um, I do find this, rather funny because we're having no problem getting insurance. It's the older houses built to a different spec, built on lower lying land with not as strong of fasteners or structural design. Those are the ones that can be built differently. Anything built 2004 or newer, insurance will look at differently. And insurance is all about risk. Over the last 10 years, we've been through some hurricanes building in so many markets in Florida. And we've been very, very minimal on our damage. They love that type of house. And although we're in coastal communities, guys, numbers don't make sense if you are investing right next to the ocean, right? We usually got to go a few miles inland. And if you look at any hurricane results, there's a risk living, it's lovely. Like I live right across from the beach, but I take a risk. And that's not a risk we take with our investment properties, and once you go a few miles inland, that does really down your risk analysis, which the property insurance companies definitely reward you with lower rates. So talk to your property counselors, look on the performers. That's from real insurance carriers that we work with. We're not having any problem, and people are usually quite shocked to see the full coverage prices we get on our properties. Um, okay, Paresh, how have hurricanes, look at that, Paresh, I just answered your questions. Newer codes are definitely helping. Again, let me give it one more personal example. My home that I live in here, I'm a 4-second walk over to the beach. It was built in 2004. I live on a little barrier island. It's only 8 houses wide, 9 houses wide. Okay, and a few right on my road to the intercoastal are small little bungalow cottages. You've probably seen the old Florida cottages. Their insurance is about 5 to 7 times my insurance, even though their house is a quarter or a third of the size of my home. And that tells you the risk analysis. You get such better lending treatment and insurance treatment, especially with hurricanes, by working with new construction. So we're really grateful that we've held strong through that, and we're getting that. Robert's really interested in your 60 unit in Ocala. Robert, no problem. Just reach out to Caitlin. We'll get you set up with one of our property counselors. It's a great property. We have some videos out me walking through the build out of it. Ocala, again, has been a really surprise market for us, guys. I remember when Chris, about 9 years ago, came to me and said, we're going to go into Ocala. And I was that, naysayer, crossing up my arms going, Ocala? It's only like 10,000 people out there, right? And I'm sure, Chris, if he's on, is laughing because he has a nice ranch out there in Allison, one of our top property counselors. But I didn't know anything about Ocala. I had never looked it up. And it has definitely been one of our strong come from behinds. So it's one of the, again, like I said, affordability is key. I'm very bullish on Ocala for sure, Robert. So we'll get you that information. So you've been in communication with Allison. Good. Well, we'd love to talk to you about that. Marion County is larger than the state of Rhode Island. Yes. Well, in Rhode Island, yep, I've heard that before too. So are the asking rental prices predetermined or decided between owner and property counselor? So Karen, when you get one of your performance, we're going to have the estimated rents on there. We do have a range that we look at. So they are predetermined together. Now, if you say you want to drop the rents, you have prerogative to drop the rents, but we have gotten pretty good. The good news is when you're building in an area repetitively, single families, duplexes, sometimes quads, you're getting a feel of the market. So, and you're following it very closely because remember, we don't just build these, we manage them long term. So we're able to determine through actual rental comps, several of them in the area, what are things renting for right now, for how much. We can add that onto our performas, so it's usually a very accurate number. Another great thing, Karen, is this can absolutely be determined, and you're going to know exactly what it is because we're renting properties in some areas so fast right now that they're already rented. So you're going to have the lease agreement in place. You're going to know what the exact amount is. So. Well, good guys. I want to apologize. That is not my New Year's resolution was to be better at tech, and that did not go so well. So I apologize. There's a reason that I'm in real estate, but we'll have that fixed for you next time. I do want to let you guys know if you're just joining our group, what I'm excited about is we're going to start doing a 1 hour masterclass every month. Every month, we're going to do a 1 hour masterclass to really dive into the experience I've had over the last 25 years, not only me, but some of our top investors, some of the shifts we've made in our investing mindset, in the type of properties we personally invest in, and why we only work in new construction. I mean, I was Mr. Rehabber. I did over 1,000 rehabs, but I won't do them anymore, or very rarely, because I'm such a believer in new construction. And we go through some of the principles and we show you how do you build that portfolio within a few short years that you can lean on in retirement, that you can have that secondary income from. And I think you're going to really enjoy it. So we'll get you out some messages on that. If you're not signed up for our newsletter, please sign up for that. We're going to start sharing a lot more information. We're very lucky to have a lot of good guidance from some really solid real estate economists, some top mentors, and we're going to be sharing that with you. And also hear from our clients. You're going to get to see some success stories, which is always nice to see. So good. Well, guys, I just want to thank you for that. Are we done? Yep. Okay. I think we answered all of them. I just want to thank you guys for joining tonight. We'll look forward to next month. We'll be putting out what it's going to be in the next newsletter. I'm deciding through a few different topics. But again, let's remember, affordability is key. You do not have to wait for rates to drop. Okay. You got to look for those two things. Keep an eye out for that. Stay away from the markets that are overvalued, where that affordability index is not lining up. We'd love to help you out. Please reach out to your property counselor. Sorry for keeping you on so late tonight, guys. Have a great night. Take care.